Exploring the investment landscape with a guru's wisdom and a strategist's insight. Good Life Companies presents The Market Enthusiast with Noah Brooks and Chris Neese.
Welcome back, everybody, to the newest installment of The Market Enthusiast. I'm Noah Brooks, and with me today is Chris Neese. We're going to talk about everything today, right?
Yeah.
We got a lot on the agenda. Let's start with some of the performance data from the first quarter. Big up quarter, right?
Yeah, we kept momentum from that big run up in Q4. Got some good returns on the indices. S&P 500 up 10.6%. NASDAQ up 9.3%. Dow Jones up 6.1%. Russell 2000 up 5.2%. I know we have mid caps at all-time highs, so we're starting to see a little bit of breadth expansion.
Yeah. We were sitting here in January, the beginning of January, talking about the massive rally off October lows, right? I mean, I don't know what the exact number was. It was up 17 or something like that off the October lows. And here we are, S&P 500 up another 10 in the first quarter. Is it sustainable? Can we continue to move forward? We're going to dive into that. We can talk a little bit about some economic data that came out. That would be a good start. Before we do that, how was your Easter?
It was good. A couple dinners with the family. We stayed home, no traveling, so that was kind of nice.
Yeah, we didn't go anywhere. We were local, just a few people. Well, few, like 15. Had a nice invite, but no traveling this time. Good Friday came and went, but Good Friday they had some economic data that got released. It's not normal.
We had personal consumption expenditure come out on a day the market was closed, so that was a little odd. So we got those numbers largely in line.
Okay. So PCE, the Federal Reserve's preferred inflation gauge, you said it, personal consumption expenditure. Really, like there's CPI, which is the Consumer Price Index, which is a basket of goods and services that the Federal Reserve, and as well as most economists look at as well for inflation data. But the Federal Reserve, they've told us that their preferred inflation gauge is actually the spending, not the basket. So us spending, so personal consumption expenditure. Let's talk about that for a little bit on our first economic data.
Yeah, so headline PCE was up 2.5% year over year. Core was up 2.8%. Both were largely in line. So we have seen a slowdown in the sort of disinflation trend. Seems like we've hit a little bit of a sticky point, but nothing that would have shocked markets. We are getting sort of the reaction this week now that the markets are open and is digesting that information. But
you say sticky, but I mean, we were at 8 and 9%, a year and a half ago, and now it's, I think the year over year you just said is 2.8.
Yeah.
I mean, is it sticky or are we just anxious about it?
We might be anxious about it. If you look at CPI, that does sort of look like it's hit a sticky point, like a little bit of a short-term floor. But PCE still has been slightly trending down a little bit. Again, the disinflation trend is slowing just a tad, but we're getting there. We've been talking about how it'll take time to go when we get to this last stretch of knocking down inflation, how it'll take a little bit longer. There's a number of factors at work. Obviously, the Fed has communicated cuts are next rather than any other hikes, which may be slowing the disinflation trend. Things might be ratcheting back up and getting a little hotter on expectation of financial conditions loosening a little bit. But, so you also have, this new trend we have, friendshoring and nearshoring, where we saw what happened during COVID with the supply chains, and we were overexposed to sort of Eastern Asia, and we're trying
Eastern Asia,
China.
I like the way you say that. That's very PC. Eastern Asia, Pacific Rim.
Yes.
Yeah.
Yes.
Yeah. So, what other economic data do we see coming out here?
Well, touching base on Easter again, I know last month we talked about Valentine's Day and what cocoa prices were doing. We talked about how it might be a little bit longer issue on cocoa prices. So obviously Easter is another big chocolate holiday.
It is for me.
Yeah. I mean, we're talking about a month and a half ago, cocoa prices were skyrocketing. They were up 40% year to date, just in 6 weeks approximately by Valentine's Day. And now we're seeing they're up 140% year to date. So they are really shooting through the roof there. So again, if your chocolates were a bit more expensive, that might be why.
And they're going to get more expensive. Now that trend really hasn't been through all commodities, right? That's more of just a cocoa trend based on some weather issues, right?
Yes.
I don't think we're going to see that. Although, you know, gas has been up, oil is certainly ticking up. I think as the situation in the Middle East gets more dire, if you will, and more players enter the game, I think you're going to see oil continue to rally up. And maybe it's just a trader's haven at the moment, but it does feel like oil is going to continue to go up.
We did have the IMF also up their GDP, their global GDP forecasts, which generally affects oil. And then we also have the EIA who increased their price target for year end as well. So some traders, like you said, probably adjusting their price targets and their exposure a little bit to be a little bit more exposed to oil.
Yeah. So one of the other things that we got this week, I think it was on Monday, was the JOLTS, right?
Yes. So the job openings portion of the JOLTS report was fairly in line. Still a lot of jobs out there, job openings being posted by employers, which would indicate a strong economy. We can't get enough people to fill these jobs. But it wasn't super hot like some of the numbers we've seen previously. It was largely in line with what was expected. I think there was 8.76 approximately million jobs. So a lot of jobs out there to be had, a lot of strength in the labor
down
market.
Considerably, right? And that helps with the inflation standpoint. The job openings were at a high in March of 2022, which was kind of marked the high of the inflation portion, or right in that general area. So they were, I think, 12.5 million job openings. And what that does is it makes employers have to raise the starting salary of those job openings to attract new employees.
Mm-hmm.
And so now we're down, 4 million jobs from that 12.5 million, 8.8 million or 8.5 million openings. And so it doesn't mean that they don't have to raise wages. I have a stat here, but it's not near as bad as it was.
Yeah, it's not a wage price spiral like we were really worried about. And that's largely a theory. I don't know how much it's been truly actually done in reality, but
wage
everybody
inflation?
fears, well, no, wage price spiral of a never ending cycle. But yeah, I don't think we have fears of that at this point, despite the market remaining
interesting stat that came out from the JOLTS. I imagine everybody listening has been in this scenario at some point in their life, whether they're a financial advisor or an individual investor. But the stat that came out was for job stayers, the annual increase was an average of somewhere around 5% in pay, and job changers, it was 10.5%. Right. So there are still companies out there offering significantly higher wages to try to entice people, which is playing into the whole wage inflation. I don't know about the spiral situation you were talking about, but there's still wage inflation intact. And I would imagine that until those numbers come down, until the job seekers, right, the JOLTS comes down a little bit more, maybe another million or two, you're still going to see those job changers have the leg up on the job stayers.
Yeah.
Right. And that affects, everybody.
Mm-hmm.
Well, speaking of that, we just saw this week, they came out in California, right? Did you see the minimum wage for fast food?
Up to 20.
Yeah.
It's a big jump.
Yeah.
I saw this comparison. It was some fast food, we'll say In-N-Out or something like that in California, minimum wage, $20 being offered to take that job. And then right next to it, on this Indeed or job seekers website, was a Montessori school teacher, $20. So we're paying.
That is tough, right?
Yeah.
$20 an hour to flip burgers, or $20 an hour to teach your kids.
Yeah. So
which one
something
is
skewed here?
Yeah, man, that's tough. I don't know. Anyway, what other economic data? Anything else?
So we went through a long period of the ISM data being very poor in contraction territory, which is below 50, as they say. But we're starting to see a slight uptick there, which would, be in line with a stronger economy, which certainly we've seen in the other stats. But both services and manufacturing ISM data over the last week has come out over 50. So
yeah,
maybe I know there's the Conference Board's leading economic indicator index, which is 10 different things that they monitor to sort of predict what the economy is going to do, if there's going to be slower growth or quicker growth. It's been negative for a long time, sort of predicting a recession. It's still way negative, but it's curling back up. And if you just look historically at those indicators, when it starts curling back up, generally it gets back to positive.
I hear somebody saying no landing.
It's
soft landing.
That's
no
the
landing.
The market's certainly pricing in at least a very soft landing or no landing. It seems like right now. Which will we get caught off guard? Maybe.
Yeah. Is it possible that the economy is actually accelerating?
It's possible. We do see, some trends saying there could be weakness, which would belie the Fed slowing down. Could keep them at 75 basis points in cuts predicted, because I was very surprised when they came out in December with 75 basis points predicted for 2024. That was aggressive in my mind, and especially with the data we've seen lately, it seems aggressive, and the market has been pushing out rate cuts accordingly.
Yeah. This sounds like a little bit of cognitive dissonance, but you have two things working against each other. You have the higher for longer, which we are definitely now in a higher for longer camp. But you have the possibility of the economy actually, I don't want to say reigniting, but continuing to be strong and getting even stronger. And so that's where I say there's this cognitive dissonance involved, is because you would think if we were going to be higher for longer, that the markets and the economy, right, different beasts, if you will, you would think higher for longer would mean that the economy is going to be slowing down.
Mm-hmm.
That's definitely not the case. I think I said this to you last week, is I don't really know why the Fed is going to lower as much as the expectations are.
Yeah.
If we don't go into a landing, if we have a soft landing and certainly no hard landing, the Federal Reserve isn't required to lower rates to go back to where they were.
Right.
If they find that it's a neutral standpoint, or even if they lower by 25 or 50 basis points and we don't get 150 basis points, which the market's pricing in, there's nothing that says that they have to lower rates.
Mm-hmm. Yeah, I think they're worried about real yields getting too high. I think they're approximately around maybe 2.6 right now. They don't want that to be at 3 or 3.5 as inflation continues coming down. And additionally, to your point, I mean, they don't want to make an Arthur Burns mistake where they cut too early and we're off to the races again. That's why I feel like they did a little bit of a disservice to all the work that they did by saying the 75 basis points in that December meeting, because it sort of took away their optionality a little bit. And now they're likely going to get towards pushing for later cuts. You've seen some Fed FOMC members coming out and walking back that a little bit, saying, they need more data before they'll cut rates, which would seem reasonable, as you were sort of alluding to. But in the latest March meeting, they released their dot plot again, updated their dot plot. It still reiterated 75 basis points in cuts this year, but we were one singular little dot from it being 50 basis points. And I don't think the market would have taken that final, again, just one dot away, would have taken that as well as the 75, even though it was just the slimmest of margins.
Well, we're certainly going to see. We'll keep everybody updated on it, obviously, but I'm going to put it out there. I don't know why they have to lower by so much. I don't know why I know why the expectations are there. They've forecasted, right? You said you thought they might have done themselves a disservice by it. And I would tell you that I'm in that camp 100%. So we talked about the markets being up in the first quarter, S&P 500 up over 10% for the first quarter. What about bonds? They're still Yeah, they're still down.
Yeah, part of the conversation we're just on. So these rate cuts are being pushed out by all the strong data, the strong economy that we're seeing here. And uh, the US ag was down in Q1 0.8% as yields just very slightly creeped up in the quarter, sort of accounting for those rates being pushed out a little bit. Remember, coming into the year, they expected cuts in March. And now we're holding on to a slight um, higher odds of a June cut, but each day it seems like they're ticking down a little bit. I'm going to stick to my July cut expectation because I just think June's too early. I think they'll try one and then they'll put it on pause. But yeah, in largely fixed income sort of been struggling as these have been pushed out. They moved very quickly at the end in Q4, and now they're coming back in just a little bit after that overreaction, we'll say.
Yeah, collecting a coupon, if you will, right? So very little, if very little appreciation in bonds at the moment,
Yes.
but collecting a coupon, which I guess is reasonable. Nothing wrong with that. Money market yields are still, money market mutual fund yields are still above 5%. It kind of depends on what you're looking at, but you can still get CDs above 5%. I saw a 5.2 the other day for 18 months. I think you can still get a 5.1 for 2 years, so not bad. But there is going to be a point where we uninvert, right? So yield curve is inverted, meaning the short end of the curve, like the 1 month or the 1 week, is much higher than the 10 year. And there's going to be a point when that inverts. It's just a question of when. I think it'll certainly be when the Fed starts to lower later in the year. We don't know, right? July, August, September. But I mean, that's going to be that'll be noteworthy, right? It'll be newsworthy that the inversion has ended, I think.
Yeah.
I'm pretty sure.
Again, we're at a record inversion right now. Going back to the US ag, it's been in a drawdown for 44 months. It's been a tough time for bonds and the aggregate, which is just usually used as the largest index, I guess, that we look at.
Sure.
So it's been a long drawdown, but eventually it'll come to an end, just like the inversion.
Eventually.
Yeah.
But I mean, I know that investors are, I don't know if the word is fed up, but they're irritated. They're irritated with the returns on bonds because bonds tend to be, we haven't really seen a lot of negative returns in bonds over the last 20 or 30 years.
Yeah.
It doesn't happen that often. And we saw 2 back-to-back years, right? 2021 and 2022. Last year, they were up 5.5%. But people are still underwater in some of those positions that they hold and, waiting to break even.
Yeah.
I hope it's going to come later this year.
Speaking of disappointing returns, so, on the quarter, we also had international underperforming the U.S. again.
Sure.
Which obviously has been a larger trend we've discussed previously. The MSCI developed ex-U.S. was up 5.2. Obviously,
compared to the S&P, up 10.
half of the return of the S&P.
Right.
And emerging markets were only up 2.1.
Yeah.
So, we certainly have some points we can discuss there, whether it be what China is doing or I had a stat on Japan. Maybe if we want to jump into that on international diversification.
What's your stat on Japan?
So in March, Japan finally broke out to a new all-time high.
Yeah.
It had been a long 34 years since December of 1989 that the Nikkei 225, their index, had been at an all-time high.
Yeah.
So during that time, those 34 long years, the S&P 500 was up 2,800%. So sometimes there is, a time to be diversified, certainly. And that's sort of why we practice our portfolio management style as we do, is if you were a domestic Japanese investor and you were far overweighted, obviously their stock market, the Nikkei 225, you'd be in a world of hurt lagging. So I wish I had the stats to back up. I would like to know what international investors, maybe in each country, sort of what the average allocation looks like. If they are as overweighted to the U.S. as we are at this point.
You mean home country bias?
Yeah, country bias.
Right. So home country bias is, I might want to invest in international companies or invest internationally, but the majority of my portfolio is going to be domestic, right?
The companies
US.
you and interact with on a daily basis.
You think, or do you have a hypothesis on this for internationals?
Well,
people?
when it comes to Japan, obviously that was a scarring wound what the market did to them, and I mean they were in a huge bubble territory. Their CAPE ratio back in 1989 was at 87. CAPE ratio being the cyclically adjusted price to earnings ratio. So they were in a huge bubble. I think people sort of understood that, but it's been 34 years to get back on a non-total return basis back to where they were in 1989.
So do you think everybody in Japan held that you do you think they have a home country bias and they just held on the entire time?
I'm not going to guess on that front if they do, but I know generally Japanese citizens have a lower exposure to stock markets than we do here in the US. So maybe they've turned away. I know if you think about China, it seems like their citizens are more exposed to real estate. They look at real estate maybe the way we look at like gold or equity, things like that. So I'm sure they shifted somewhat and and that's why they have less equity exposure than we do.
Okay.
Generally,
I'd be curious to know, like a British citizen and what they have in terms of domestic versus their version of international.
mm-hmm.
We should come back to this.
Yeah,
we should make a note of that one.
Yeah,
I don't have
good
any
research topic.
I don't have any data on that. I don't even. Yeah, we'd have to.
We'll check it out for you.
We'd have to come back to that. So a few things happened to me over the Easter holidays. One I thought was awesome. I needed something and I went out to the store and they were closed. That was just a quick thing that happened on Sunday afternoon. They were closed, which I thought was awesome. This trend of businesses being open on holidays like Thanksgiving. I know Target a few years made a decision to close on Thanksgiving after being open for so long. And I think that's great. The few days prior to that, though, I went into the same store and we had a boatload of stuff that we were getting. So we weren't hosting Easter, but we were, bringing some stuff for Easter, and we got to get all the fixings and all these little things that you buy. And my wife, she decided she was going to use that self-checkout thing. And when you go in, if you only have 5 or 10 items, self-checkout, no problem. But here we are. We have a full cart, not a mini cart, a regular size cart, a big old cart, and we're using the self-checkout. And I'm telling you, it is one of my biggest pet peeves. Those things are horrendous for me. I feel I just
please place the item in the bagging area.
I keep yelling to myself. People have got to be going, this guy's, he's an idiot. I get so angry and I don't know why. And I know that they're trying to stop theft, right? So you can't put the bag down and then take it off, but you're like, I already scanned it, right? And so one of the things that happened out there, I don't, there's no end to that story. I really despise those things for large shops. But one of the things that I saw this past week was a bunch of companies are getting hit on their earnings calls for increased shrinkage, which is theft. One in particular, Five Below, kind of a dollar store type of place. Not something that I go to a lot, but apparently they have a lot of these self-checks. And they noted in their earnings report that people are just stealing, and the total shrinkage was dramatic and really cut into their earnings per share. And they've talked about, specifically Five Below's talked about reducing the number of self-checkouts. And then yesterday I read that Amazon is doing away with their, is it no checkout, where you can just walk out in the whole stores and things like that. So I would love it if they just added more cashiers and I didn't have to do my own checkout. Yeah. I feel like they should be giving me some type of rebate or payback.
Yeah, that would make sense. That'd be a good idea, like a 1% off for bagging your own stuff. I mean, yeah, it's tough. If you're there during non-peak hours, it's like there's only 1 or 2 cashiers at the grocery store or what have you. And it's like there's a massive line for people, like you said, who have full large orders, and it's like, gosh, get in line. 7 more people to go.
Talk about pet peeves. So Friday was Good Friday. It was March 29th. It was also the 25-year anniversary of the first time the Dow Jones closed above 10,000. Now, I don't know where you were in March 29th of 1999. I was working at a company called Prudential Securities, and I was studying for my Series 7 at that time. I was a wire operator. Back in the day, they used to give you paper tickets to buy and sell things. And it was like a free-for-all in the office. Now, I don't remember exactly. I don't think the manager had hats made up.
I love seeing that on the floor when they're passing out the hats.
Right, passing out yeah. So they were definitely passing out Dow 10,000 hats at that time.
Mm-hmm.
I don't think we had them in the office, but it was a big deal. I'm pretty sure that the manager might have brought in some alcoholic beverages or some lunch or something like that, and people made a big deal about it. So that was March of '99, and then we topped out. We got almost up to 12,000 before the tech bubble, collapsed, if you will.
Mm-hmm.
And then during that time period, 2000, 2001, 2002, it was, 3 bad years in a row, back to back to back. Dow wound up well under 9,000 at that time, not including the global financial crisis, right? We got down to 6,666 during that time period. But if you look at the total return now, right, going back 25 years, March 29th to the end of business on, Easter holiday, the total return, not including dividends, so I guess it wouldn't be total return, the price return for the Dow Jones is up over 300%. When you put in dividends, when you add those and you reinvest those dividends and you let them compound, the total return is over 500% for the Dow Jones. And that included a lost decade, right?
Yeah.
The 2000s were essentially a lost decade. From January 1st of 2000 to December 31st of 2009, the total return on the Dow Jones, not including dividends, was negative, I think 10%, 9 or 10%. So, compounding, putting those dividends back in, not pulling the trigger and selling out, total return still over 300% in 25 years. I mean, is it great? It's not the worst thing ever. 300%.
But the power of compounding is evident.
Power of compounding. Yeah.
Well, while we're on that point, we did have some change in the components that we haven't covered or talked about. So
yeah,
we had Amazon actually went into the Dow Jones. Obviously, it is a price weighted index rather than cap weighted. So they went in as the 17th largest position, and they replaced Walgreens Boots Alliance, who was having a bit of a tough go of it. But Walgreens Boots Alliance, they decreased 58% since they became a component within the Dow.
Well, that's always the story, right?
Well, Dow does have this issue with performance when things come in. It seems like that happens time and time again, that they struggle. And sort of on that same point, it was down 58% during its tenure in the Dow. It had replaced General Electric, which is since up 86%.
Right. And so Salesforce was added a few years ago. As soon as it was added, it had a really rough year.
Mm-hmm.
I think it's positive since it's been added at the moment, but it does seem to be. So is that the people at Dow Jones being late to the game, or is that them?
It sounds like it. So how does it work when they decide? They do have sort of like a committee that decides on that, and yeah, it seems like they're kind of late. They're not the best investment pickers, we'll say, at least in the short term.
Okay.
But on the S&P 500, we did also have SMCI Super Micro Computers, one of the storied stocks from this year, which has really gone crazy over the last year. And Decker Outdoors came on. They replaced Whirlpool and Zion Bancorp, and that was on March 18th that they went into the index.
So based on that idea of companies outperforming after they've been removed, do you buy Whirlpool now?
Possibly. I'm not sure if S&P 500 has that same issue that the Dow kind of has, but potentially.
Okay. Let's talk about performance a little bit with some of the different sectors, right? So obviously, technology has been leading the way for a number of years. Is it possible that it's slowing down?
I think it's definitely it's digesting gains where we're at here. So in Q1, energy was actually the leader, up 13.5%, followed by financials, who are up, I think, 12.4%, and industrials up 11%. So it did seem like a slight changing of the guard or a sector rotation, which is something that would be a positive development. I think we want to see that. Again, we've always talked about the breadth expanding, and sector rotations within bull markets are very healthy and sort of help sustain the rally. So I think rather than tech going off a cliff, they're taking some time off of doing all the legwork for the indices.
Yeah. I have some, I don't know if they're competing stats, but I have some shorter term stats, some 1 month stats.
Okay.
Best performing sector for a month, energy, up 12.5. Worst performing sector, consumer discretionary. Second worst, technology, down 1.7% on a month. Now that doesn't, I don't know that you can extrapolate that throughout the remainder of the year or anything, but it's certainly interesting to note. Second best performer for the month, utilities.
There's a shock we haven't seen in
right?
a while. Yeah.
Like nobody wants to own utilities, and all of a sudden they're really moving. So maybe, just hypothesizing here, if investors think yields are going to go down in fixed income, obviously lots of companies benefit from that. But if you're looking for a dividend and rates are going to go down, then utilities might be the place to find those dividends.
Yeah, it looks like they're moving a little bit before any Fed cuts to, make up for maybe they see that's where people are going to go when people eventually maybe move out of some money markets or out of some of these other positions, getting back into a nice dividend paying ute.
Yeah.
Stable ute.
Yeah, something we haven't talked about in a long time. Now, this isn't really a utility, but I want to just bring up the Francis Scott Key Bridge for a second. It's not a utility, it's not an industrial, but it's major harbor for commercial shipping. Obviously, you look at those pictures on television, and when you see it from a helicopter, you think, well, that's not really. It's not a giant bridge, but when you get closer on the pictures, you realize how big this bridge actually is.
1.6 miles.
Yeah.
I think it is. Huge bridge.
Yeah. Now they just opened up a very small lane for smaller boats, not big commercial boats, but for smaller boats to get through. And it looks like it's going to take a long time.
Yeah.
Now I know some people in the industry, and they're telling me that a lot of the shipments are going to be diverted to Norfolk, Philadelphia, even, I guess, Boston to some degree. How much do you think that impacts? So we know about supply chain issues from COVID, right?
Yeah.
In terms of getting things from China to California or China to New York, whatever it happens to be. Is this how much of an impact is it gonna have? Is it really gonna make a difference?
I'm sure we probably are able to shift around the logistics to make it so it's not a huge penalty. I mean, the biggest imports were vehicles, I think, farm equipment, sugar and salt. And then the major exports out of there were, I think, coal, LNG, and other metals and minerals. I think we have the ability to shift it around to, Philadelphia, New York, down to Norfolk. I think it will have a small impact, but, those logistic people, they're very good. They have lots of computers and things that can optimize the trips and reroute things. I think it'll be okay. I don't think it'll have a major impact.
I guess what I was going for is it enough to be inflationary? I hope not.
I hope not as well.
Right. I don't think it is because of the availability of other ports locally. So I don't think it's going to be inflationary. And if it is, it might be more regional.
Yeah.
Right. So if new cars, take a little bit longer to get to the Baltimore area, could raise the price a little bit because now you have this intermodal transport. You have to get it from whether it's Philadelphia to Baltimore or from Norfolk to Baltimore.
Yeah.
Maybe a little bit.
Yeah.
but not on a national level.
Yeah, especially some of that farm equipment is pretty sizable. So there will probably be a slight hiccup, like you said, regionally. But I doubt it'll flow so far through to like CPI and PCE.
Yeah. As we starting to wrap up here, you talked about compounding for a little bit, and I think it's really important. I came up with a stat all by myself. No, I didn't. I actually saw it. Someone else posted it that I'm going to take it. But the stat was on Berkshire Hathaway and Warren Buffett. And so Mr. Buffett right now, he's 93 years of age. Everybody knows he's the Oracle of Omaha. His net worth is $138 billion at the moment. And the stat was that 98% of that net worth came after he turned 65, which I just thought was amazing.
Yeah.
Because we get a lot of people that as they age and as they start their journey of retirement, that they think, hey, all of a sudden, I've been a 70-30 investor for the last, 10, 20, 30 years, or I've been a 100% stock investor for the last 20 years. As they get closer to retirement, they think, oh, now I have to make this massive change from what I've been doing because people say I should be more conservative as I get older. And I just want to put this out there, dividends and compounding, and you look at Buffett, it's very possible that normal investors shouldn't have to make that change. And the last 10 years of Berkshire in their compounding, the last 10 years of his net worth has been exponential, right?
Yeah.
I mean, it's just been straight up. And it's not that Berkshire has had this tremendous return that all other equities or all other indexes haven't had. It's been okay, right? So I just want people to start thinking about that, the power and the effects of compounding.
Compounding is why we use log charts, not linear charts.
Let's save that one for another day. All right. Anything else here to wrap up?
I think it's worth noting China, where we're at there. So China has been having a tough go of it. Obviously, they've had some real issues in real estate. Their market's been getting hit as well. It looks like in Q1 it might have stabilized a bit. That would be helpful as well if we're just talking about globally, keeping the rally going. It'd be nice if they could participate and help out, because to get a soft landing, you really would have thought that China would have had to do decent, or at least, balance out. And we're starting to see them balance out a little bit. And they've signaled that they're more open for business now that they've been in struggles. They want to stem the bleeding, per se. The Chinese number 2 is meeting with American CEOs again, sort of opening a dialogue. I assume that they're open for business. They fired their equivalent to our SEC regulator, head of the SEC on their end, sort of at the market bottom. And I think that was another signal to Chinese markets that they're going to have a lighter regulatory touch. So Yellen's meeting with them this week, I believe. There's a lot of things. Seems like they're going to maybe take a step back in fighting us just a tad in the meantime to benefit their markets.
So you're saying communism doesn't work?
I'm saying, yeah, what they were doing before is certainly tough on businesses there. As we know, some people have said they had become uninvestable just due to sort of the bipolar nature of how they would regulate. Yeah. If they just decide you made too much money last year, they're going to come down hard on you. And that's not good for businesses and innovation.
Yeah. You heard it here first, everybody. Communism doesn't work in the stock markets. Okay. That's what I'll leave it as. So to summarize, I'm going to go back to the market is volatile, but compounding of returns is like the golden ticket. Don't stop compounding. Keep it going. Reinvest everything you can. And in the short term, there's always a reason to sell or not to invest. But in the long term, do not bet against the American economy. Thanks, everybody, for listening. We'll see you next time on The Market Enthusiast.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.